If you watch my other videos on how to sell your business to private equity, you might be curious as to what goes on behind the scenes of a multi-million-dollar private equity deal. Well, in this video, I'll talk to you about the various components of a deal, the stages, what makes up an offer, some of the documents involved, and a whole bunch of other information that perhaps you wish you didn't have to learn. Regardless, if you want to sell your business, you'll have to learn about these topics at some point. Might as well get a head start by listening to them here. If you don't know, my name is Nick McLean with 4 Pillars Investors. I've been in the M&A and private equity space for about 20 years now. Can't say I know it all, however, I have been around the block a few times. This video is the latest installment taken from my book, How to Sell Your Business to Private Equity. In this section, we'll talk through the common chronology and components of a PE deal, acknowledging, of course, that all deals are unique. To start, what is a private equity firm? A private equity firm is an investment manager who raises money for a fund in order to pursue a given investment strategy. This capital usually comes from large institutional investors, such as pension funds, endowments, hedge funds, etc. But high net worth individuals, and sometimes PE investment managers themselves, also invest in these funds. In this structure, the investment manager is what's known as a general partner, or GP, and all of the other outside investors are limited partners, or LPs. With the capital in place, the investment manager then sources investment opportunities and invests the fund's capital into equity ownership stakes of companies that fit the fund's overall strategy, with the goal of generating positive returns for the investors. Unlike passive investors, however, PE investors often take an active involvement in the companies in which they invest, working with leadership to accelerate revenue growth, expand margins, and generally increase the worth of the company for all involved. Some funds do this by focusing on growing sales, while others look to reduce costs, but the general idea behind it all is the same: improve the value of the investment. For more information about the structure of PE firms, the Wikipedia article here is helpful. After the sell-side advisor has performed their diligence, requested and received certain documents, and prepared the marketing materials, i.e. the teaser, NDA, and SIM, the process officially starts. The sell-side advisor will email a list of buyers that the sellers have approved and send them the non-confidential teaser and the NDA. The sell-side advisor will likely take the first call alone with each party that returns the NDA. After that initial call, some sell-side advisors will then allow the prospective buyer to talk to the business owner, while others might require a term sheet or indication of interest first. At some point in this middle stage of the process, prospective buyers will get access to a virtual data room, or VDR, although it might be limited prior to the LOI stage. A VDR is an electronic depository of wide-ranging documents about your business. The next step would be a call for offers. The components of a term sheet or IOI will be described in greater detail in a subsequent section. After IOIs are received, a select few will get invited to management meetings held on-site at your facility or at a neutral site. At this meeting, you and your team will give a deep dive presentation of your business. The sell-side advisor will likely take point on preparing the presentation, but will seek your input. After the management meetings, the advisor will ask all interested parties to submit an LOI. After the LOIs are received, 1 or 2 get picked and negotiations start. After negotiations conclude, either the LOI is signed or the parties end the process. If the LOI is signed, due diligence begins in earnest. When going direct, the process is a bit more fluid. It will likely begin with informal discussions between you and a member of the private equity firm. You might have coffee at the business or meet for lunch and then take a tour. Many sellers will suggest that the quote-unquote stranger is with the insurance company or something non-threatening like that. If the PE firm is interested, it follows a similar process to the above, except in this case, it just deals directly with you. There will be an NDA, at some point an initial offer, request for documents, etc. I would imagine that the process will move as quickly as you want it to, with the exception of the LOI submittal. Many PE firms will require the LOI to be approved by the investment committee prior to submission, which is a good thing really, in my opinion. The process post-LOI would largely be the same as well. Inside the process, there are several items that have an outsized impact on the deal. Some of these require discussions and/or negotiations with your buyer. Others are more of a decision that you need to make. In terms of structuring the deal, some sellers don't give much thought to their role post-close. perhaps because they're of the mindset that they will never work for someone else and thus want to be 100% out or bust. Well, if you feel that way, it certainly is your prerogative, but it will likely impact the size of the prospective buyer pool. Regardless, there are a few different roles you can take. As a seller, post-close, the seller transitions out immediately. This option is most successful when you've been running the business, quote-unquote, absentee for a period of time, and you can make the buyer confident that the current management team is fine without you. If the buyer is not convinced of that, then a gating item for them will be the identification of the CEO to run the business post-close. Seller stays on in an advisory or consulting role and/or as a board member. This is more common, but again, it requires much or all of what is required when you transition out entirely. Seller is CEO and/or a board member. This option is often the most attractive to buyers, especially when you are still active in the business. Even when you are not, there is still an appeal to retaining you in this role because of your vast experience. If you want to decrease the importance or the amount of rollover equity, it might be a good idea to transition out of the business well in advance of a potential sale. And I don't mean promote someone to president or CEO, but you keep calling all the shots. This can't just be for appearances. It would need to be the real deal. In addition to potentially reducing rollover equity, it might increase the attractiveness of your business overall because it would be seen that the business has a full operating team that is performing at a high level. There are countless strategies and considerations when trying to agree on a valuation. In fact, my single longest video I have ever recorded is on this very topic. Regardless, some sellers have a firm price in mind and will choose to communicate that to the buyer in a kind of take it or leave it scenario. Other sellers might prefer the buyer to make the initial offer. Independent of your style, a lot of thought is required here. I think the best analogy for this is comparing the buyer and the deal to a spouse. When choosing a spouse, what's going to be more important? Superficial features like looks, or building a life with someone you actually want to spend time with? The psyches of the buyer and seller are also important to consider. As a seller, you'll have more confidence about the business than buyers will, part of this being due to the endowment effect. I described the endowment effect in greater detail in another video on the status quo bias. Additionally, buyers need to be skeptical because they have a fiduciary responsibility to their investors. Think about it. Your financials probably don't change by the exact same amount from year to year. Sure, you might achieve growth in most years, but perhaps not in all the years. And though your margins might not change a great deal, there likely will be some level of fluctuation. These factors, and countless others, are why it is hard to value a business and even harder for the buyer and seller to agree on what a business is worth. Another valuation challenge is about buying at a peak. It happens quite often that I see a business that's had good growth over the past 2 to 4 years and its current levels of EBITDA are higher than they have ever been. The seller will likely be confident not only that those levels will be maintained, but also that the growth will continue. And because this growth will continue, a premium price should be paid. But why is this growth happening? What has changed? And will this change persist? These are the questions, among others, that buyers will try to answer when evaluating a company that's had a recent run-up in profits. Because, after all, it does seem coincidental that the seller wants to sell right at the point when the company is doing better than it ever has. As a brief digression, I want to discuss a comment a seller made to me. How long does it take to get your name out there? I was working on a deal in which 5 or so years in the historical period were right around a certain level. Then there was a significant increase in revenue and earnings over the last 3 years. So in this case, we had 8 years of financials to review. We asked the owner why the company was growing, and we couldn't get a good answer. At one point, the answer offered was, well, I think our name and reputation are finally getting out there. But this company was almost 30 years old. It was hard for us to believe that after 27 years, the company was finally starting to get discovered. You might not think I should have been skeptical, but most buyers will be. Additionally, here are 5 other examples of deals we worked on in which we found it hard to get to the seller's value expectations. 1. Key man risk. This company had EBITDA margins of 40%, and there was a real story for how growth could be achieved. However, there were only 3 or 4 employees, part of the reason for the higher margins. The seller indicated that he would stick around post-close, but the rollover component was lower than we would have preferred, and the cash component was lower than he preferred. We actually were able to meet in the middle on this one. 2. cyclical industry. I've mentioned that cyclicality is a negative in terms of valuation. On this deal, we took the time and expense to survey investment bankers to get a feel for what companies were trading for in this size range and industry, as it was a $30 million plus EBITDA business. We presented our findings, but the current owners decided it wasn't enough. 3. Going back to the trough. I'm certainly open to renegotiating, but when someone gives me their word that this is the final time they will ask to negotiate, I hold them to that. On this deal, that assurance had already been given prior to an in-person meeting to tidy up all the loose ends. Well, sure enough, the seller again wanted to renegotiate the purchase price. I felt as though the trust had been broken, and we decided to abandon the pursuit of this deal. 4. CapEx. Our position is that companies we acquire should be current with what I call maintenance CapEx. This isn't about buying new equipment to reduce cycle times or pursuing new business. It's about making sure that the equipment you do have functions as was intended. Shortly before closing, if a seller spends a lot of money on maintenance CapEx, we are unlikely to increase the purchase price for that expenditure. However, if the expenditure is to increase capacity or something similar, we would. I've worked on deals in which one or both of these situations occurred. 5. Unwillingness to accept off-balance sheet liabilities. As mentioned in other sections, there are sometimes off-balance sheet liabilities that the seller might or might not want to accept or recognize. The buyer would want protection from these, though, at a minimum, through stronger representations and warranties, though likely the buyer will attempt to quantify the amount of the potential liability and require that amount to be escrowed. Deferred and/or contingent consideration is any form of consideration for your company not paid in cash at close. These forms will often be included when discussing the total enterprise value. These types of consideration are included because the buyer wants the seller to have a financially vested interest in the company post-close. Think back to the used car analogy I mentioned in a previous video. You, as the current owner, have a much fuller understanding of the business than the prospective buyer does. The new buyer will likely trust you, but there is no denying that incentives are not aligned when at the closing table, as any additional dollar paid to you comes from the buyer. It's a zero-sum game. Deferred and/or contingent consideration is used, therefore, to help align incentives. With these types of mechanisms at play, incentives are more closely aligned post-closed. Not perfectly aligned, but more closely. These types of incentives are most common when the seller is deemed to be critical to the organization. The acquisition is a platform acquisition for the PE firm. The PE firm has less experience in the industry. There is a gap in valuation expectations, and a whole host of other reasons. Deferred and/or contingent consideration can be very lucrative, though. If you retain 25% ownership in the new entity, your payout when the new owners sell in 5 to 7 years could be 50% or more of the initial payout. This is called a second bite of the apple. Our internal target is to target a level of growth whereby the seller's second bite of the apple is as large or larger than the initial transaction. Now, if the company doesn't do well, the proceeds from these components of the purchase will decrease in value, potentially to zero. Like in many other areas of a transaction, there certainly is risk involved. Regardless, our experience is that 100% cash transactions are very rare for PE buyers on a platform deal. There are 3 main types of deferred and/or contingent consideration. 1. Rollover equity. Rollover equity is when the seller maintains an ownership interest in the company post-close. The amount of rollover equity should be specified in both dollars and percentage of ownership in the entity post-close. 2. Seller financing. Seller financing is less common in lower middle market deals than in SMB deals, but it still happens regularly. In SMB deals, it happens almost 100% of the time. Seller financing is simply a loan from the seller to the buyer. The term would likely be at least 61 months, depending on the senior lender. Interest rates would be higher than senior debt rates, but lower than mezzanine or subordinated debt rates. Why 61 months? Some senior lenders will not allow another form of debt to have an earlier maturation than theirs, which likely would be 60 months. 3. Earnouts. Earnouts are most common when there is a gap in valuation that needs to be bridged. For example, let's say your company just landed a new customer. You think that customer will bring in $3 million in revenue over the first full year of working with them. However, the sale of your business might come before you even start selling to this customer. This would be a good place to use an earnout. The mechanism behind an earnout is that if certain financial metrics are achieved, then the seller will be entitled to additional consideration. There are about 1 million different ways to structure an earnout. A revenue-based earnout will not be very attractive to a buyer because of the perceived ability to game the system and bring in additional revenue at low margin or even a loss. EBITDA-based earnouts are most common, in my opinion. Earnouts could be based on 1 year of performance or more. I would say the sweet spot is 2 to 3 years. While this might seem relatively straightforward, it is often complex. The primary reason why asset purchases are preferred by buyers is because an asset purchase limits the buyer's liabilities to a certain degree. If you buy the stock of a company, you get the whole kit and caboodle. With assets, the off-balance sheet liabilities remain with the selling entity. This decision is often very important to the seller because of the potential impact to after-tax proceeds. Depending on the situation, a stock sale might save the seller millions in taxes. Why? When stock is sold, the proceeds are taxed as capital gains. When assets are sold, the difference between the sale price and book value is treated as ordinary income. This issue is definitely more acutely felt by the seller because the tax bill would potentially be larger, period. For a buyer, they usually can still deduct the same amount, though the deductions might have to be amortized over a period of 15 years in the case of goodwill. So the tax deductions will be the same, the deductions just won't be able to be used as quickly. Other considerations when determining if an asset or stock purchase sale would be optimal. Does the company have any contracts that need to be maintained? If so, a stock purchase might make sense. Even though benefits will likely not change materially, in an asset purchase, the seller will have to terminate all the employees and the buyer will have to rehire them, essentially simultaneously. This is done often, so there isn't a risk here, just a bit more work. It is worth noting that even in an asset purchase, the new entity will still be on the hook for certain liabilities. The IRS will, in all likelihood, deem the buyer to be a successor entity. We are at the limit of my willingness to speak on this complex issue, though. In a lower middle market deal, there will almost always be a Q of E analysis performed. The purpose of the Q of E is to closely analyze the financial statements to get an accurate view of how much the company actually made on a GAAP and apples-to-apples basis. The GAAP portion of the last comment is pretty straightforward, but perhaps not the latter part. When saying that part of the Q of E is to analyze the financials on an apples-to-apples basis, the idea is to determine if there are any revenues or expenses that were non-recurring or non-ongoing, or perhaps a supply contract was renegotiated, or utilities went up or down. All of these, and many more, might factor into Q of E adjustments. Another key topic is revenue recognition and expense matching. Revenue recognition can be a complex topic for some businesses, but essentially the concept is that the company must report revenues when they are earned, not when they are billed. Further on this topic, expenses must be matched to the revenue that is recognized. These topics are easier to understand and abide by when dealing with discrete products, while services can be much more difficult. Here are a few examples of how a Q of E analysis might treat certain transactions. 1. The company spent $50,000 repairing a roof and expensed 100% of that amount in the year in which it occurred. Since replacing a roof would increase the useful life of the asset, and because it is a material amount, the expenses associated with replacing the roof should be capitalized, not expensed. The net result to net income would be positive $50,000 minus any additional depreciation. The net result to EBITDA would be to increase it by $50,000. 2. Company recently entered into a raw materials contract and is expected to save $100,000 next year and each year thereafter. One of the purposes of the Q of E is to get a feel for what EBITDA would be next year based on current conditions and currently known facts. For this reason, it might be supported to include an add back of $100,000 due to this new contract. After all, the buyer will benefit from this new contract. 3. The company sold a vehicle for $20,000 with a book value of $0. Typically, gains or losses on disposal of assets are captured in the non-operating income or expense line item. If this company recorded this revenue in that type of line item, then it would not get added back because EBITDA would exclude all non-operating income or expenses. If it was included above the non-operating income line, or there is no classification for non-operating income, then it potentially would be an add back. 4. The company owns the real estate but does not record any rent expense. Most PE buyers prefer to buy operating assets devoid of any non-operating assets such as real estate. Because of this, if the seller wants to sell the real estate as well as the business, the buyer might arrange a simultaneous sale-leaseback transaction, or SLB. After the SLB, the buyer would not own the real estate and would have to pay rent. For this reason, the Q of E would probably deduct a fair market rent from EBITDA to account for this. 5. The two owners and their spouses took a trip to the Bahamas and, while there, held a planning session over lunch one day. All of the expenses from this trip were deducted. It could be argued that this trip was personal in nature. Because all personal expenses will be added back to EBITDA, the expenses for this trip likely would be as well. I discussed the concept of working capital and how it might be calculated in an earlier section, but it is worth fleshing out this concept here. At the end of the day, the buyer of a lower middle market business will require that there is enough working capital remaining in the business post-close to run the business in the ordinary course. So, even though you might feel like the money sitting in AR should be yours because the revenue was earned while you were the owner, in almost all cases the buyer will require that AR be conveyed to them. Lower middle market deals trade for higher multiples than SMBs, and this is one reason why. I think this can be a difficult concept for some to grasp, partly because it is relatively unique. Think about buying a car though. Even though the cost of a tank of gas is inconsequential when compared to the value of the car, the buyer still expects there to be enough gas in the tank to operate the car. As it relates to businesses, working capital is the gas. It's just that working capital is often a more meaningful portion of the overall purchase price. Put differently, a multiple of cash flow is typically higher than the book value of assets. So to some degree, the buyer is already paying a premium for the assets. By removing a large chunk of those assets, the delta would be even larger. I will be blunt here. If you get a document from a buyer that has a line for your signature and/or theirs, have your attorney review it. We have all reviewed contracts in our day, but the stakes are huge here. The non-disclosure agreement, or NDA. There are a few provisions within the NDA that I will look for. A term of 1 to 2 years is fairly typical. If a longer term is asked for, I would push back. With whom data can be shared. Some NDAs provide a list of the types of people that can review confidential information. This might include advisors, accountants, attorneys, etc. Others are much narrower. Non-compete, non-solicitation. These clauses can have wide-ranging implications and are a key area in which your attorney will be able to provide good counsel. When should you discuss valuation? This is probably obvious, but different people will have different styles as to when to talk about valuation. My own personal preference is to discuss this early and definitely more than once. I've heard both sides use the terms like fair price or market price, only to be quite surprised when actual numbers are used. The term sheet or IOI. What is the purpose of the IOI? The IOI is there to make sure that the parties have something in writing that addresses at least some of the key financial components of the deal. We have all had miscommunications about both trivial and serious matters. One important part of the IOI is to help reduce the potential for miscommunications. Is there a benefit to going straight to the LOI? Perhaps, but I wouldn't say that it's a huge benefit. Sometimes the groups want to move more quickly. If that is what you would prefer, then by all means indicate to your buyer that you want to move directly to an LOI. If you've hired a sell-side advisor, then you likely won't be able to forego this step because it's used to determine who gets invited to management meetings. The following are some common elements in a term sheet or IOI. Purchase price, often expressed as a multiple of trailing 12 months, TTM, EBITDA, and in a range. For example, 5 to 5.5x. Type of purchase, i.e. asset or stock. Amount of ownership being purchased, expressed as a percentage. Cash consideration. Other components of the structure, such as rollover equity, seller financing, and/or earnouts. Timing. Due diligence requirements and/or considerations. Other legalese such as non-disclosure, non-binding, etc. Please note that I would advise against accepting a term sheet that requires exclusivity. The letter of intent, or LOI. If you receive an LOI, the private equity group is very serious about a transaction. That said, most of what is in a typical LOI is non-binding except for the terms around exclusivity, non-disclosure, governing law, etc. Purchase price and structure. The LOI reconfirms the agreed upon price and purchase structure, stock purchase, asset sale, etc., though with more detail than in the IOI. Also, the purchase price will be a fixed number, not a range or multiple of EBITDA. Escrow amount and timing. One new concept that will be introduced in the LOI is the need to escrow a certain amount of the purchase price. The escrow will serve as a source of funds to indemnify against reps and warranties, as well as true up working capital. Closing conditions, also called conditions precedent to closing. Potential roadblocks to closing are laid bare, from financing requirements to regulatory approvals. Addressing these up front allows for proactive problem solving and prevents 11th hour surprises. Exclusivity. The LOI will likely bind the seller to exclusivity, barring the seller from entertaining other offers. This grants the buyer focused access for due diligence while evaluating their investment in the potential partnership. Reps and warranties. The seller makes certain assertions, a representation or rep, about the company's financial health, legal compliance, intellectual property, etc., and promises to indemnify if such assertions turn out to be false. This is without a doubt the area that gets negotiated the most. Perhaps not at the LOI stage, but definitely at the definitive agreement stage. This is a strategic choice, and there are folks in the camp of, let's get as much squared away prior to entering exclusivity, and folks in the camp of, let's give this a go and see what works. I'm in the latter camp for this primary reason. At the LOI stage, I'm not entirely sure how flexible I want or need to be on reps and warranties. Waiting to negotiate allows us to be more specific as to why we need to hold firm on a specific rep or warranty, or why we can be flexible. If we had to decide now, then we can't be as lenient. Next steps. The LOI outlines the timeline for due diligence, the process for addressing contingencies, and the estimated closing date. This roadmap ensures that both parties work toward a shared objective with clarity and efficiency. A word on earnest deposits. It is very rare for private equity groups to agree to a deposit of any amount for a deal in the LOI phase. This happens sometimes in S&B deals, but not always there either. If you're going to require an earnest deposit and your company is large enough to be in the lower middle market, then that requirement will lead to a much smaller pool of prospective buyers. One final piece of advice here would be to ask if the buyer had to get the LOI approved by its investment committee. Ask a follow-up question to determine if or when the transaction will need to go through the buyer's investment committee again. If you thought reviewing the LOI was fun, just wait for the definitive purchase agreement. Whereas the LOI might be 5 to 10 pages long, the definitive agreement will be 30 to 70 pages. I'm not going to go into great depth here because this is where the attorneys take the baton, to a large degree. The attorneys will negotiate the legal points and bring the business points to you. Diligence. Remember, selling a business has similar elements to selling a car. Where this will definitely hit home is in the diligence process. No stone will be left unturned. Questions will be asked in many different ways and perhaps multiple times. There is no malintent there. It's just a result of the fact that numerous people are involved, and folks will forget some pieces of information even though they have been told it already. What are some of the elements of the due diligence process? What follows is a non-exhaustive list. Q of E. As mentioned, a Q of E will be required. Different buyers will handle this differently. Some will kick off a Q of E immediately. Others will wait until some amount of diligence is performed. Generally speaking, once a firm initiates the Q of E, that is a good thing because it means they are spending hard dollars on the deal. It is a fair question to ask the buyer when the Q of E will be kicked off. Reps and warranties. Reps and warranties will be addressed fully in the definitive agreement. Though I do not plan to review the definitive agreement in depth, I do think it is important to explain certain aspects and terms related to reps and warranties. Knowledge qualifier. This qualifies the rep by adding the language to the knowledge of the seller or perhaps to the actual knowledge of the seller. The concept here is that in some circumstances, you are able to represent a fact as true or untrue solely based on the knowledge you have. Our watch, your watch. The concept here is that the seller will indemnify the buyer for any third-party claims related to an event or circumstance prior to the closing. Likewise, if a third-party claim relates to an event or circumstance post-close, the seller will not be liable. If an event occurred while you were the owner, you are responsible for the costs associated with satisfying that liability. Caps, usually used in conjunction with the term baskets. A cap is the limit to which a seller has to indemnify the buyer. Depending on the issue, this could be a percentage of purchase price, 100% of purchase price, or unlimited in the case of fraud. Baskets. A basket is similar in concept to a deductible on an insurance policy. Let's say that the buyer and seller agree to a basket of $20,000. In the simplest case, this means that if the buyer's claims for indemnification are less than $20,000, the seller does not have to pay any money to indemnify it. If the amount is greater than that, say $50,000, it depends on the type of basket. A non-tipping or deductible basket means that the buyer would not get indemnified for the amount of the basket, in this case $20,000. A tipping basket would mean that the buyer gets indemnified $1. In actual dollars, a deductible basket would mean that the seller is required to pay $30,000, and a tipping basket would mean that the seller is required to pay $50,000. On one of our deals, reps and warranties represented an impasse on the deal. The sellers weren't willing to escrow additional funds. The resolution? A reps and warranties insurance policy. These policies will cost at least $100,000, but are sometimes worth it. The process is very involved, and the diligence call with the underwriter is akin to being on the witness stand. But even with the cost, which is typically shared by the buyer and the seller, it was well worth it on this deal, with the benefit of hindsight, of course. Debt to finance the transaction and the impact. The buyer will likely use some amount of debt to finance the transaction. This is yet another hurdle that must be tackled, albeit a necessary one. Most firms will apply leverage of 2x to perhaps as high as 4x EBITDA, or 2 to 4 turns of debt. For those that are debt averse, this won't be ideal, but debt is common in M&A transactions and larger companies in general. Even if debt isn't required at close, it is almost a certainty that there will be debt at some point due to growth or owner liquidity, perhaps. Commercial diligence. The buyer will want to make sure that your customers are happy and want to continue their relationship with your company or even expand it. This is obviously a very sensitive subject and needs to be approached carefully. There will be a lot of work done to understand the current customers, if they might grow or reduce business, and how painful it would be to switch suppliers. Background checks. The buyer will ask for background checks on all shareholders and key employees. This will likely include a hard pull of your credit score. I would strongly encourage you to list any legal action you have been party to, whether it was a lawsuit, a bankruptcy, or even a divorce. Absolutely be upfront if you have a criminal record. One method we've used in the past is to outsource this part of the process to a customer satisfaction consulting firm. This firm would call a handful of your customers and try and find out how your company could earn more business, or at least continue to maintain at current levels. Because they are pros at this, these firms are often able to uncover actionable intelligence. Of course, they never mention that there might be a sale of the business. Employment agreements. The buyer will require key employees to sign employment agreements. Some employees think this is a good time to negotiate a pay raise. While they are perfectly entitled to hold that mindset, if there is a meaningful adjustment, it will impact EBITDA and perhaps purchase price. Well, you have to sign a non-compete. It is a certainty that the buyer will require all owners to sign a non-compete. Given that the buyer is paying the seller a large sum of money, that non-compete is likely to be enforced by the courts. However, the courts are increasingly voiding non-competes, especially for those earning an annual salary of less than $250,000. Because of this, advise your employees to seek their own counsel when evaluating whether they are willing to sign a non-compete. At some point prior to closing, the buyer will need to talk to a handful of key employees. The size of that handful dependent upon the size of the company. Almost no seller wants that to happen, but it must. So prepare yourself and your employees for this eventuality. This actually is an opportunity for the employees to make a great first impression. Insurance benefits, diligence, and process. The buyer will work with a broker to conduct diligence on the various insurance policies in place, as well as look for gaps in coverage. This broker will also evaluate all benefit plans. This work cannot be done by the current broker because that firm would be conflicted. Because a new firm is needed to do the diligence, that will be the firm that gets the business post-close. It's unfortunate for your current broker, but that is how it typically works. It's hard to summarize a vital and comprehensive topic such as this. Perhaps the takeaway should be a recommendation to rewatch this video to make sure that most of the information is understood and, ideally, internalized.
Well, I'm not going to say I hope you enjoyed this video because it was fairly complex and went into a lot of detail. However, I can say that I hope you found some benefit from it and feel more prepared whenever you go into a potential sale transaction, or at least the lead up to a transaction. If there are any questions, I would love to talk to you directly. There's a link in the comment section below that would allow you to book a discovery call with me. Would love to hear from you, and as always, thanks for watching.